All right, well, our next guest has been compared to Warren Buffett for the way he picks stocks. Jay Bowen runs the Tampa Firefighters and Police Officers Pension Fund. He's outperformed most of his competitors over the years, so we welcome back a man who some call the Oracle of Tampa. Jay, welcome.
Thank you. Good to be here.
You've heard the discussion here. What do you think is likely to happen in the stock market when tapering does happen, whether it's December, January, or otherwise?
I agree with your panelist in terms of the tapering being bullish. I mean, after all, who wants to be in a perpetual state of monetary life support? That is going to get you nowhere, as Japan has demonstrated over the last 20 years. So I think the market will applaud and welcome the normalization of interest rates if it's occurring for the right growth-oriented reasons. And by that I mean higher real rates of interest in terms of forecasting higher real returns on capital and an increase in economic activity. So in that respect, I think that the tapering is bullish. I think the Fed is going to have the Yellen Fed is going to have two big objectives in 2014. I think they're going to want to change expectations, number one, regarding inflation. They want higher, there's a core group that wants higher inflation. And number two, the longevity of their zero interest rate policy. I think they're going to want it firmly, and they're going to want to change expectations in terms of how long that's going to be in place. After all, let's remember, coming out with that employment report on Friday was core PCE data, and it was off again. That's their preferred measure. The core PCE fell again in October from September to October to 1.1%. So price stability is their other mandate, and the tapering will commence in 2014. But the zero interest rate policy, I think, is going to be in place for much longer than some expect, which means a steeper yield curve, which I think is bullish for stocks.
What stocks in particular do you like in this environment? Again, we made reference that some people call you the Oracle of Tampa, and the people that you invest for, the firefighters and police officers down there, certainly think you're a lot like Buffett based on the stocks that you've picked and the performance that you've had. Where should we be putting our money right now? Yeah,
we're top down and thematic, and we're looking at, from a global standpoint, I think there could be a significant reallocation of capital into the industrial sector based on relative valuations and better global growth prospects, and also safe and secure dividends. So we're looking at a couple of areas. We continue to be intrigued with this shale revolution. I know that it's not a new theme, but it continues to manifest itself in ways that baffles and confounds the experts. You know, we're producing over 1 million barrels a day from both the Bakken shale region and also the Eagle Ford region. I mean, this was unheard of 5 years ago. We like the railroads in terms of transporting oil.
Anyone in particular? Any railroad you like in particular?
We really like Canadian National. They're unique in a variety of ways. From a financial standpoint, we like their operating ratio and their free cash flow. We also very much like their tri-coastal footprint, geographical footprint, from Nova Scotia to British Columbia and then north-south down to the Gulf of Mexico. And we also like, it's not just oil, the supplies in and out of these shale regions, they're very focused on sand. And in fracking, sand is the new gold. And Canadian National is spending $6 to $8 million to upgrade their network in Wisconsin to ship more sand out. So that's another kicker. Also, their exposure to the ports in Western Canada. China is now the biggest importer of crude. And that also plays into Canadian National in terms of their ability to ship crude to these Western ports in Canada.
Hey, Jay, just a real quick question on Canadian National. The stock's had this huge run off September from about 48 to where it is right now, up in the mid-50s. Trading at 15 times next year. You think they can actually expand that number, or you think the top line's going to grow a lot for 2014?
Well, we're very long-term oriented, trying to look out 3 to 5 years, and you're right, on a current basis, it's not particularly cheap, but and the stock recently split 2-for-1, and they announced a significant buyback also. We think that they're perfectly capable of earning $5.50, $6 a share over the next 5 years, which I think is the type of situation. It's more of a 3-4 yards in a cloud of dust, where in 5 years you'll look back and say, wow, this stock has given me a compounded annual return in the low double digits, which we think will outperform the market.
Hey, Jay, it's great having you on the show. Thanks for coming back on.
Great. Good to see you again.
All right, happy and healthy New Year, and we'll catch you on the other side of that. Coming up on the Halftime Report, Facebook versus Twitter.